What's up, guys? Todd Robinson with the Robinson Review. Hope you're doing well. Hope you're doing great. I wanted to record this podcast episode. Really, I'm going to focus on deal structuring. Okay. This is a solo episode because I just need to drop some game, drop some value on you guys about how to structure multifamily deals in particular, but also you can apply this to any kind of commercial real estate, how to structure these deals legally, compliantly, and the different various types of structures. I think we're going to go through 6 structures, okay? 6 different types of deal structures that you can use to purchase real estate. And we're going to use a hypothetical buyer, all right? We're going to call him Bob, right? Bob is going to consider each one of these structures when he goes through his acquisition time frame. Now, Bob is going to buy this hypothetical property. It's going to be $1 million, all right? It's a $1 million property. And it's 10 units, right? So $100,000 per unit. Bob is going to buy it. Now, the first easiest structure, we're kind of going to go from easiest to hardest, okay? The first easiest structure is really just Bob has cash. Good for Bob, right? He has cash. He's got $300,000. We're assuming Bob's going to get a loan for $700,000, right? So you've got $700,000. You've got $300,000. That's your purchase price. Luckily, good thing for Bob, he's been saving up his whole life and he's got $300,000 of cash and he's able to purchase the property. He's at least able to come up with a down payment because that's not all you need, right? And when you're buying a property, you need also to raise money for or account for somehow closing costs, okay? Acquisition fees, if we're talking about syndications, reserves, right? Lender is going to have some reserves. And so it's probably in $1 million property. Maybe he's got to bring in $400,000. But the easiest, simplest structure, Bob has cash. A single member LLC is formed, right? So one operating company that Bob is the sole member of. That borrowing entity, that company becomes the borrower with the lender and owns the property, owns the real property. So that is it. Bob buys the property, he then runs it, and he has cash flow, right? So that's structure number 1. Simple, easy, single member. You've got some cash, you buy the property, you go on about your way. Well, what if Bob didn't have $400,000 sitting around, okay? What is he going to do? How is he going to buy this property? He really wants to get into multifamily. What are the ways for him to get into multifamily? Well, let's say Bob has some wealthy friends. Bob plays golf at the country club and he has tea time every Friday, and he's able to ask some of his golf buddies if they could go in with him. And so the next structure number 2, is structured like this. Bob asks 4 of his friends or 3 of his friends to put in $100,000 a piece, right? Bob has $100,000, but he doesn't have 400. All he has is 100. He asks 3 other friends, put in $100,000 a piece. Now, Bob and his 3 other friends are buying this property. They have $400,000. 300 goes towards the down payment. The other 100 goes towards reserves, operating costs, and the like. Great. What have we done? What's the legal structure that we just created? If you said joint venture in your mind, then you are correct under one important distinction. We're assuming, and this is the second structure we're going to talk about, joint ventures, right? In that structure, all of Bob and his friends, they all have to be active in what? In the company, right? They have to be active in the company. They have to actually have some participation in order to be considered a joint venture, right? Doesn't matter that there's only 4 of them. What really matters is they're active in the company. So assuming this operating agreement that Bob now has his lawyer draft, if it's my client, I draft it. And the operating agreement will say all 4 members are what? They're active in the company, meaning they participate in decisions, they have voting rights, they have some control. Maybe they make decisions via unanimous consent. That's not required. You could make decisions via majority vote, right? But the fact is the company is ran by the members. There's no manager. And that is a joint venture in a nutshell. So we have a single member with the cash. We've got a joint venture with a couple of guys that want to put their money together and buy a property. Now, what's the third type of structure? Let's say this is now similar, but maybe Bob isn't so well off and doesn't go to a country club. Maybe he's just a normal working guy, but maybe he's working at a tech company or a healthcare company or a startup or a manufacturing company, and he's got, let's say Bob has $50,000 saved up, but he still wants to get into multifamily and he still wants to buy this property, but he can't come up with the cash himself, and his other three friends, they only have $50,000 also. So that's 150 plus Bob's 50, that's 200, right? So how are they going to come up with the other 200? Well, Bob is going to go to some other friends and family that he knows, and he's going to get each of them to put in $20,000 a piece. Okay. So that's 10 more people. Now we have a total of 14 people in the company. Well, you can't really have 14 people as a joint venture. That's a lecture for another day. But in this instance, the people that he talked to, even his country club buddies, they don't want to be active in the company. They don't want to participate. They're like, Bob, here, take our money. We don't want to have any role in the company. You just do what you need to do. Make sure you give us a rate of return. Make sure we're getting some profit sharing, and you do your thing. Okay. What has Bob entered into? What is this legal relationship? This is called a real estate syndication. Because it's a real estate syndication, it is subject to securities laws, securities regulations. It has to be structured appropriately and correctly. Okay. So as a real estate syndication, the operating agreement looks very different. All of the members do not have voting rights. It's usually managed by a manager, right? The manager is Bob in this instance. Doesn't have to be, but it is Bob. And then all of the other members are passive. They're what we call limited partners. And those limited partners, they have no voting rights, no control. They have no say-so at all in the operations or the performance of the property. That, my friends, is the definition of a security and therefore is a syndication according to the law. Now, the United States Supreme Court defined what a syndication is by defining what's called an investment contract. And that was in 1947, a case called U.S. versus Howey. And in that case, there was a couple of elements that were true that define what an investment contract is. And it basically is this. The promoter, in this instance, Bob, he's promoting the deal. He takes someone else's money and he promises them what? Profit, rate of return. Okay. Here's the kicker. Solely due to the promoter's efforts. So what does that mean? Well, Bob is running the property, right? The other partners have no say-so. Since Bob is running the property, Bob's efforts are going to be the sole reasons why they hopefully execute their business plan and turn a profit. Okay. That is the definition of a security. So that is the third deal structure, type of structure that you can use to purchase real estate. Okay. Now, that structure also has pros and cons. You have to deal. Now, Bob has to deal with 14 different investors. He's got to have strict and strong reporting mechanisms. He's got all these fiduciary relationships. So it becomes a little more burdensome, but he's now buying $1 million property with only having to put $50,000 down. Very worth it, right? I mean, that's how you scale. And folks, that is how you scale in multifamily. It's how you scale in real estate, by using other people's money. Okay. Bob figured this out when he enlisted his friends to join him in this venture. And he structured the operating agreement in a way that he was the manager and his friends were not. They had no voting rights or control, and therefore he created a real estate syndication. The fourth type of structure is what's called creative finance or seller financing. Everyone, creative finance sounds all mysterious, but guys, it's really not. All it really means is the seller is financing your equity. Okay, so what does that actually look like? Some people don't understand this, and it's important to understand the distinction. So in our example, let's say that the seller owns the property free and clear. And since he owns the property free and clear, he's got no debt on it. At the closing, he may have some expenses, depending on what state it is, for the title and escrow and the closing costs and whatnot. But let's say he's going to net $950,000, right? He's going to put that in his pocket. Well, rather than putting that in his pocket, he's going to take $300,000 or $400,000 in this instance, and he's going to give it to the buyer. Now, he's not going to just give it to him. It's going to be it's going to be documented. The buyer is going to basically borrow that money from the seller. Okay. And so on the actual closing statement, and this is kind of the nuts and bolts of how it works, on the closing statement, the seller, rather than getting the $950,000 cash, he's only going to get $500,000 cash. Hopefully you're following me in your mind. He gets $500,000 cash. The other 450 or 400 rather, or let's say he gets 550, sorry. The other 400 gets transferred to the buyer on the closing statement. Okay? So it's a paper transaction. It's not like the seller writes the buyer a check. You got to understand that. It's not that. Seller doesn't write the buyer a check. It happens on the closing statement, and it's a part of the closing process. And so then on the buy side of the closing statement, the buyer will have a credit from the seller for $450,000. That is seller financing. Now, the buyer and the seller also enter into some documentation. Now, in this instance, we do have a senior lender that's going to put $700,000, going to loan the buyer $700,000. So when that's the case, you need to be very careful on how you structure the equity that's financed by the seller. A lot of lenders will not allow you to do that, right? They may not allow you to fund 100% of the equity by the seller, because then you what? You don't have any skin in the game. So without any skin in the game, the buyer, the lender's going to be like, well, if the property goes south, then you don't really even care. You can just walk away. So that's going to be your biggest hurdle in getting over the hump if you were going to get the entire equity check from the seller. I would recommend not getting the entire equity check, putting some skin in the game so that the bank can finance you. And so that can be through, you put in 50,000 and you get another 350 from the seller. And it's going to be under some debt instrument, right? Some terms. Also, the lender doesn't really want another lien on the property. So a lot of times you're not offering true security. And so that's it in a nutshell if you're funding the seller equity. Now, a lot of seller financing deals, they are funding the entire thing, right? So it's like basically your seller becomes your lender. You don't have a senior lender. You have the seller that comes in and finances the whole thing. So in our $1 million multifamily property example, if the seller owned it free and clear, the seller would fund, let's say, $800,000, 80%. And by doing that, then the buyer in that instance only has to come up with $200,000 to close the deal. And maybe he can do that through his joint venture or his syndication structure. But that is another way to finance the entire transaction without using any banks. That's probably the most likely scenario in a seller financing deal. Now, there's another way to structure a deal. This is still, I think, within our fourth category of seller financing. And that is that the seller reinvests equity into the buying vehicle. Okay, not a lot of people understand this, or they don't know how to do it. So rather than executing a promissory note and executing, a note that you have to pay the seller back, the seller becomes a Class A member and an investor in your deal, in your buyer's entity. And typically that would be through a syndication, right? They don't have any voting rights or anything like that, but they become a part of your equity structure. And lenders are usually okay with that, but there are some instances where a lender could reduce their loan amount to you because of this structure. I mean, I've seen that before lots of times. I've even had on personal deals where there's a $75,000 credit, repair credit, and for some stuff happening at the property, and the lender reduces their loan amount by $75,000 because they don't want to participate in anything where the seller is giving their equity. They want the buyer to come up with the equity because it's about a risk game, right? It's risk, it's allocation of risk, it's having skin in the game. That's what lenders are concerned about. So I think we're on to 4, right? Single member LLC, the joint venture, the syndication structure, seller financing is number 4. Number 5, I guess seller financing debt and then seller financing equity. That's 4 and 5. Number 6, we're going to talk about preferred equity. What is preferred equity? That's usually when you're getting into institution type investors and family office type investors that write big checks, right? So the syndication structure is really what we call retail investors, investors who are going to write a check for 50, 100,000, $200,000, right? Now, an institution could write a check for, I mean, they go, sometimes you have to even have bigger deals. They won't write a check for a $400,000 deal, right? It may need, $5 million, for instance. But preferred equity is another way to fund the capital stack and fund the equity stack. And a lot of times they can go up to 90 or 95% of the entire deal. It's like I always say, it's like fighting with one hand behind your back. I mean, you can take large checks like that, but you're kind of doing a deal with the devil in some instances because they are going to hamstring you and be on top of you and make sure you're doing your job. Okay. And you're going to have financial reporting requirements. You're going to have business plan requirements. You're going to have, they get their distributions first typically. And if you miss anything or you mess up, they can then take over, right? People don't understand that. They can take the LLC over. Now they don't have a deed on the property. They don't have a deed to secure debt on the property, but they do have what's called takeover rights. And takeover rights means they can come in and remove you as the manager. Boom, you're gone. You're out. Big pref equity guy from New York is coming in. They're running the show. And that happens quite often. This last downturn, it has happened too many times to count. Okay. And usually you do not lose your equity in that instance. It's very important. You don't lose your equity position. You don't get diluted. You just lose management control. If your operating agreement says that you get diluted, you need to negotiate that pretty hard and get that back in, because you should not be in that position to be diluted. Now, a lot of times they'll parse that out, which means, if they're removing you because of some fraud or willful misconduct or negligence, then yeah, you're going to get diluted. But if they're removing you because the market tanked and they need more money and you don't have any money, or the economy tanked, or the tenants are bad, or whatever the case may be, that it's not related to fraud or willful misconduct or neglect, then they will remove you as a manager and you still keep your equity position. So we've got just cash, right? The guy who's got just cash. We've got joint venture. We've got syndication structure. We've got syndication equity, syndication debt, and we have preferred equity as our sixth structure. These are lots of different ways to purchase property. And so, the biggest thing that you need to do when you're getting ready to acquire a property, is you got to get all these ducks in the row first, right? You've got to make sure you've got your financing lined up. You got to make sure you understand how you're going to fund the equity. Is it going to be through one of these structures? You got to understand the difference of the structures. You got to make sure your title is good. You got to get your insurance guys to look at it. You have to get your tax guy to look at it, because taxes are likely going to go up. So you've got to get all these pieces in place before you can jump into a purchase of a multifamily property. So I hope this has been valuable to you. I wanted to just drop this quick podcast to describe the different types of deal structures, and growing from there. I mean, like I've always said, syndication is the way you scale. Using other people's money is the way you scale. Eventually, most people, they will get some sort of programmatic joint venture partner, like a family office or institution, and then they can buy 10, 15 deals in 1 year with the same partner. That happens quite a bit, and you can scale up to 20, 30, 40,000 units at that point. At that point, you have a major company, right? But that's usually what most people do. Now, there are guys out there that have been doing this for 30 years that never have taken any institutional money at all. They just, syndicate each deal with friends and family. And that's a perfectly acceptable way to fund your transactions. But if you want to get true scale, going the joint venture route with some sort of financial institution or larger equity player is not a bad way to go. So I hope you've enjoyed this. Make sure you like and subscribe. Give me some reviews on podcast. On Spotify or Apple Podcasts, wherever you're listening to this. And I will see you guys on the flip side. Peace.